I've been trading for over 35 years now, and I'll say this, you can make money trading even if all your entries don't go your way. Now, trading is risky. This isn't financial advice. Most people lose money doing it, but if you're stubborn enough to keep going despite the odds, you can make serious money from it. What I'm about to show you isn't some complicated strategy with 50 rules you need to memorize or perfect setups you need to wait weeks to find. Let me show you what I do. Imagine betting on a horse race where you can keep betting after the race starts. That's kind of what we're doing, only smarter. Let's say you enter a position, set a stop loss, and if the market goes against you, you take the loss and you move on. That's the standard approach. You're either right or you lose money. Let's say you buy at 100 and price drops to 95. And 95 is still a level that makes sense for the trade. That's where you decide to buy again. You're paying less per share. You're putting more money in as price goes against you. So instead of needing to be right about direction from the start, I'm using the market's movement against me to build a position that only needs a small natural bounce to become profitable. I can be temporarily wrong 1 or 2 times in a row about where the market's heading initially and still make money when it rallies. Streaks of incorrect calls are mathematically guaranteed in any trading approach. So instead of trying to predict perfectly, you ride the trend. This is the way to survive those losing streaks and turn them into opportunities instead. Sound too good to be true, right? The catch is that the only way for this to work is if your position sizing is structured correctly from the very beginning. Imagine running a marathon where every mile you go, your shoes get lighter. That's what increasing position size does to your average entry. First, to size your entries correctly, you need a trading system with escalating position sizes. And here's how that works. I place my first entry with a small position size, let's say 1 to 2 or maybe 3 contracts. If the market moves against me by a predetermined amount, I enter another position at that level. Not just adding 1 more contract, I'll buy the same number of contracts as before. And yeah, I know what you're thinking. This sounds absolutely insane, Raghee, but let me give you real numbers. Say you enter at 100 with 2 contracts. Price drops to 97. You buy another 2 contracts. Now price drops to 95. Now you buy 4 contracts. We're doubling the size. By the time you're at this third entry, 95, you're holding a cumulative position where your average entry is 96.75. Now the market only needs to bounce from 96.75 to a 100 level, which is a pretty small move, and you can close all the contracts for a profit. But the system only works with precise price spacing for the entries. I use volatility indicators like the price movement range to determine exactly where each entry should be placed. During calm markets or narrow ranges, I tighten the spacing between the entries. During volatile markets or wider ranges, I widen it to avoid getting overwhelmed by the price swings. Now, how do you know when to exit? Simple. Once the price hits my initial target, I close at least half my position with no exception. The system lives and dies by that disciplined exit. Now, before we continue, if you're finding this helpful, make sure to subscribe. I've got new videos like this coming out every week. Know that using this approach can generate consistent wins, but it can also wipe out your entire account in a single trade if you ignore one critical risk management rule. Here's the reality. You've been taught that entering multiple times to a losing position can lead to total disaster. And for 99% of traders using it wrong, it is. But here's the difference. This trade risk is only 3 to 5% of my total capital. So even if the trade is a loser, and they're going to happen, my total portfolio barely feels it. I call it a paper cut. I also use the system in a healthy trend to avoid getting obliterated. If the market shows sudden directional momentum, prices trading with higher highs and big gaps, I don't run in to buy at the high and the irrational exuberance. I wait. The worst thing you can do is run this system by buying into the higher highs and hoping it goes higher. That's hopium. That's how accounts get wiped out in hours, not even days, when the inevitable pullback happens. My operational goal when I first started was really simple. Double the account, withdraw the initial capital, and keep trading with house money. Once I've pulled out what I put in, every dollar that's left in my account is trading from profits. This changes the psychology completely. You stop being afraid of losing because you're already playing with winnings. Now, all of this risk management is pointless if you don't understand one market principle that makes this work. And that's something that happens in every market every single day. Mean reversions. Think of markets as rubber bands. Stretch them too far and they snap back. Price moves away from its average because of news, liquidity, or emotion. But eventually, that momentum fades and price normalizes back towards the mean. Moving back to the mean is called a pullback. When this happens in a trend, you have a powerful level for entry. I use exponential moving averages, anchored volume-weighted average price, as well as support and resistance to identify where that mean, that pullback is. The key is knowing that the more consecutive moves in one direction, the higher the probability of that eventual pullback. If you see 3 lower lows in a row, you're likely heading towards support or demand, waking up the buyers as the market is getting stretched lower. And statistically, the likelihood of a snap up in the direction of the trend increases. This is why my scaling entry system works. I'm not guessing where the support will be. Instead, I'm waiting for measurable reversions to the mean, a pullback, and then I'm scaling in as that move finds the buyers. The further it goes into my pullback zone, the bigger my position gets because the probability of a trend resuming is getting higher. But, and this is critical, this works best in uptrending markets. If an organized trend takes hold, the market is more likely to be mean reverting, pulling back and then bouncing. And that's where this system really shines. This is the part where most traders picking tops because the market can't go any higher. Ignore the warning. Please don't be that trader. That's why I use the trend. If the market is showing sustained directional strength, I jump in because betting on the move after the mean reversion, buying that pullback in a trending market is how you grow an account. So the real skill isn't just managing risk or sizing positions correctly, it's knowing when the market conditions actually support this approach and when they don't. All right, theory's done. Let's talk real numbers. Understanding mean reversions or pullbacks is critical because execution is everything. Let me show you what happens when you actually run this system in the market under real conditions. All right, this is where theory meets the actual trading, the part they don't show you in the back tests. About 62% of my trades close at break even after a 25 to 100% profit. The system works because I only need a small bounce to hit my first target and close half my position with a gain as that trend is resuming. The reality is that with this strategy, you'll be grinding out frequent 25 to 50%, even 100% plus wins to offset the occasional, inevitable 25% loss. Even with a 75% win rate, there's an 8% chance of hitting 7 consecutive losing trades within any 100 trade sequence. It's statistically guaranteed to happen eventually. Now, if you manage this correctly, you're looking at 25 to 50% returns. And that's not bad, and that's not get-rich-quick risky money. But those returns mean nothing if you can't execute. And executing this strategy while your account has unrealized losses is psychologically impossible for most traders. Just imagine having to buy at another entry while your account keeps going lower. You're fighting loss aversion, sunk cost fallacy, and every cognitive bias screaming at you to stop. Having a process removes that. Without it, you'll fail. So yes, this works, but only if you have the capital, the discipline, and the emotional detachment to let the system run exactly as designed, even when it's uncomfortable. All right, so now you know a way to profit even when wrong when using multiple entries with escalating position sizing. This requires strict risk management, disciplined stops, defined trading account exposure, and following the trend. If you like this approach and you feel like you want to learn more, I put together resources in the description below. Now, trade smart, manage your risk, and remember to watch this next video.